questions about the economy, and we will not call him Mr. Doom anymore, or Dr. Doom. So Tim, come on out.
It's a great intro, right?
Thank you. Thank you. Good morning. What a talk, right? He only got one thing wrong. I am not a doctor. I do not have a PhD. No, so much of what Shane talked about today is going to be really good information for what I'm about to tell you. Yes, the world is uncertain. It seems a bit scary. I'm going to show you some pictures to tell you why. We'll dig into what that means. But there are things out there. There are opportunities out there. We forget that during periods of volatility, there are ways to find opportunity. And so I don't want that to get lost as I'm showing you a bunch of charts going down today, because those charts have gone down before. They will go back up. So a little bit about myself before I jump into this. Who are you talking to? Why should you care? My name's Tim Mahedy. I've been at KPMG for about a year and a half. Prior to that, I was a chief of staff and senior advisor to President Mary C. Daly at the Federal Reserve Bank of San Francisco. So I live in San Francisco. It's approximately 6:30 a.m. my time, so cut me a little bit of slack. I haven't had enough coffee yet. But my area of expertise no one cared about it. I was the guy at the parties that sat in the corner and kind of just, oh, hey, I'm talking to you about inflation, which is what I study. And right now I'm soaking up my 15 minutes of fame. So what a wonderful world. And that's where we're going to start today. We're going to start on inflation. And I'm going to try and move through some of the high-level statistics and break down for you what's going on and why it matters. As Shane talked about, he actually said this backstage. I'm going to mess up the quote, but I thought it was a great quote. He goes, all models are wrong, some models are right. Or all models are wrong, some models are useful. That's what he says. It's always going to mess it up. Should definitely hire that guy. So, and that's where we are with inflation, right? Like you can ask 10 different economists what their inflation forecast is, and you will get 10 different answers. So I want to help us think, why are we getting to where we are? So when you're looking at the data, when you're thinking about your business opportunities and where you can go to help your clients, thinking about how, like the sequence of events and what goes into the model is more important than thinking about the outcome. So I can't start talking about inflation until we address the gorilla in the room, which is the supply chain, right? It is surprise to, I'm sure, no one in this room that we have had the most disruptive sequence of events. It wasn't just the pandemic. People forget that what happened in the Suez Canal, and then kind of these knock-on effects. We had the most disruptive sequence of events that we've had in modern history to our supply chains. It wreaked havoc. So what are you looking at here? You're looking at two charts. On the left, you have supplier delivery time. So this is survey data. It comes from the ISM the ISM Institute, and they ask a bunch of purchasing managers, folks who buy things for their companies, a whole bunch of questions, and they come up with an index. And so I'm going to show you two components of the index. The first is supplier delivery times on the left, your left, and then on the right's a backlog of orders. So what I want to show is that if you go back to January 2020, everything above 50, by the way, on both of those indexes, is not just that things, for instance, it's not saying the supplier delivery times are getting tighter or longer. They are, is that they're doing so at an increasing rate. Keep that rate piece in mind when you look at these charts. Above 50, that rate is increasing. Below 50, you have declines. So you can see that we saw those enormous shocks in both the manufacturing and service sector, and now we have those things rolling off. So you have supplier delivery times improving, and you have backlogs of orders, which is very important, particularly for automobiles, which is included in the manufacturing sector. That is also rolling off and coming under 50. So things are easing. That inflationary pressure, those disruptions that were causing this disequilibrium between supply and demand, those are rolling off. So then you would say, okay, great. What does that mean? My slide here. So what does that mean for inflationary pressure, right? Okay, so we've all heard the story. Supply chain, we're short on truckers, we're short on boats. we should see inflationary pressures easing. And to some extent we are. That's what I'm showing you in this chart. You're looking at two lines. That dark blue line is headline CPI inflation. That's the number you see in the Wall Street Journal when you wake up and you see 9%, 8.5%, 7% year-over-year inflation. That's the dark blue line. You can see it's at a multi-decades high. I could take this back all the way to the 70s and 80s, and you would see this is the highest it's been. That's why you get the 4-decade high headline. What I would also show, I didn't because it's hard to see what's happened recently, but if we took it all the way back, what you would also see is that in the late 70s, early 80s, that number was higher. It was double digits, higher than we peaked at during this cycle. So while it feels like the 1980s and there are some very interesting similarities, this is not the Paul Volcker Fed era. We won that fight in the 80s with inflation expectations, and we benefit from it today. So it is an uncertain time. It's a scary time when we talk about inflation, but it is not the worst it's been. Keep that in mind. On top of that, just like I showed you in those previous two charts where you have supply chains easing, you have inflationary pressures easing. You say, oh, okay, Tim, well, you know, there's all kinds of prices in the economy, right? You have some go up, some go down. How do I know this isn't a blip? We've seen prices ease actually earlier this year, and then they went back up. Well, what the New York Fed does is they have an underlying inflation measure. That's the light blue line. They strip out not just food and energy to give you core inflation. That's what a lot of monetary policymakers look at. We'll talk about that. They strip out a whole bunch of other stuff that moves up and down. They have a model, sometimes useful, that also shows you can see that it gives you a better underlying measure. Just you can eyeball the chart because it doesn't move around as much. And you can see that measure is also coming down. So we have likely seen the peak in inflation this time. That's good news. One of the reasons that I'll delay here, sorry. One of the reasons that we think that inflationary pressure is going to come down is that what we think about inflation is a huge component of actual inflation. What do I mean by that? So, okay, you go to the grocery store. I live in San Francisco. I have 2 young children. I can tell you the blueberries used to cost $8 a box. And in the middle of the pandemic, they went to $14. And I was like, what? $14 for blueberries? Also, you live in San Francisco. You should expect that. The key component of that was not that I paid $14. Is that I think I was going to be paying $14 6 months from now. Because if I did think that, I would go to my boss at KPMG, I hope they're listening, and I would ask for a sizable raise, right? Because my situation has changed. But if I thought blueberries were going to go from 14 back to 8, then maybe I wouldn't be so concerned about those inflationary pressures. And that's what the Fed is tackling. They're trying to change our minds. They're trying to convince us that inflation is not permanent. And so what we did, there's lots of ways to talk about expectations. There's a really good survey at the University of Michigan that comes out, it's been going on since the 50s, that asks people, hey, what do you think about inflation and the price of all these different things? We decided at KPMG Economics to go on a 3-year odyssey of asking clients, CEOs, C-suite folks, people making pricing decisions, what they thought about inflation. Because if you're going to get to the heart of where you could see that pass through from supplier deliveries to that, are they going to compress margins to final products, you would talk to the folks making those decisions. And so we started this in the 3rd quarter, and we've now done 2 surveys. And what you're looking at here is a comparison between those two. So we asked folks, hey, what do you think the 12-month rate of inflation is going to be 1 year from now? Then we asked them what they thought it was going to be 5 years from now. Why did we pick those windows? The 1-year inflation expectation window really gives you a sign of kind of what decisions they're being faced with now. It's a pretty standard look. It often tracks commodity price movements. That's what we know from doing research. The 5-year expectations is, we think that's, and this is again, it's not KPMG economics, but economists think that's far enough out that should incorporate your information on what you think the long-run equilibrium in the economy is. So 2 things. First, If you look at the one-year expectation, 7.4%, 6.7%. Those are really, really high numbers, but they're coming down. That's good news. That chart I showed you before with the rate of inflation coming off, that's fueling these. That's helping bring inflationary pressures down, showing you the Fed's winning some kind of fight. Same is true with the 5-year window, right? So we've got prices coming down and people believe that. It's credible. That's really good news for the Fed. But we're not out of the woods yet. What you're looking at here, okay, great. Past the peak. What's going to happen in the next 12 months in our view? So I just showed you CPI inflation. I'm not going to dig too much into the weeds. This is a slightly different measure of inflation called core PCE. There's two reasons I'm showing you this. The first is it's probably in the view of many that this is a better measure of actual inflationary pressure, and to build on that, it's what the Fed tracks because of that. So the Fed looks at this core PCE measure. There's slight differences between CPI and PCE. They move very similarly. Core means stripping out food and energy because, as we've talked about, you want to get an underlying sense of where inflation is, and food and energy tend to move around a lot. As we're seeing right now with energy, food has been kind of had a very strong growth rate for a while, so that's not as true. But just know this is the Fed's measure. So when they're talking about getting inflation down to 2%, they want those blue bars to meet that pink line. So the light blue is where we've been, right? 5.3, 5, 4.9. These are, again, 4 decades highs, just like CPI inflation. Okay, well, what's going to happen through all of next year in our view? And you can see, again, we've come past the peak, and we've got inflationary pressures easing, but they're not back down to the pink line by the end of next year. They're above. And you'll say, well, Tim, is 2.3 really that different from 2? And the answer, as any good economist would tell you, is it depends. I make that joke because we're famous for saying on the one hand and then on the other hand, right? So I'm going to try and give you some tangible information to take away. In our view, that it does matter because those 30 basis points is still above the Fed's target, and the Fed is afraid of the last picture I showed you with inflation expectations not coming down enough. So we see inflation coming down. We see it really easing towards the middle to end of the second quarter next year. End of the second quarter, early third quarter. And what is that? Why is that? This is somewhat, endogenous. The direction moves both ways. Why is that? And what does it mean for Fed policy? Well, one, it's doing that because Fed policy is as strict as it's been in decades. So this chart, bear with me, it's a little bit confusing at first, but this chart is the cumulative interest rate increases after the Fed's first move. So all that I want to draw your attention to are the two lines on the left and then kind of like the bottom right. That bottom right kind of purplish line, that's Fed policy following the global financial crisis. It was the longest expansions since we've seen since 1945, partially because monetary policy was very accommodative, meaning interest rates didn't go up very much. Where are we now? We're the pink bar. So that is the Fed is raising rates 75 basis points at the fastest pace since at least the 90s, goes back to the 80s actually, and it is the most restrictive we've seen policy over the shortest period of time. 75 basis points used to be an emergency move. It's normal right now. When I was at the Fed, we had our first kid 3 days after the emergency Fed decision to drop rates in 2020. And I remember I was actually headed to the hospital, and I was on paternity, my first day of paternity leave, and I told my wife, I'm like, this is it, right? I mean, like, we went up to like a little, almost 2, we're gonna drop rates to 0, and it's gonna be at 0 for a long time. That was my forecast back in 2020. How wrong I was. We're at, and we think the Fed's gonna keep going. So we say, okay, well, what do you think? We're gonna get a 50 basis point increase in December, and we're gonna get a couple more that ends us at 5.5% by March of next year. Very restrictive. Okay, so you got questions in your head probably saying, all right, this guy's showing me that we've got really high inflation, tightest Fed we've seen in decades. Where's the R word? Don't worry, I've got some recession slides. Why are we not in one, right? I mean, I'm sure all of you that read the Wall Street Journal, the New York Times, you'll notice that while we're talking about the economy and how bad it is, we're not yet saying as economists, as a profession, that we have a recession. And the first reason, there's a couple, the first reason is the labor market. I'm gonna pause here for a second. I should have said this at the top. I can talk. My wife tells me that all the time. And this is a really complicated issue. So as we go through this, there are mic runners out there. Please don't wait to have your questions at the end. We can do questions at the end. But if you have a burning question as I'm going through these slides, please raise your hand or shout it out, and we'll address it in the moment. I think that's probably the best way to deal with kind of these things. So I'm going to show you a lot of information. Okay, so the labor market. It's strong, but for how long? Everything in economics is about supply and demand. So the first place we have to look is say, well, what is the demand for labor? Because that's going to tell you how strong the economy is. And what I'm showing you here is a chart that's the ratio of job openings. So they go out there and say how many openings still are out there, and they divide it by the number of unemployed people. Now why? Because unemployed folks, to be counted as unemployed in government statistics, you have to tell the government you actively looked for work in the last 4 weeks. You're someone that wants to work. So presumably, you're low-hanging fruit. So when you look at that ratio, it tells you, okay, how much demand is out there versus like the easy, low, the folks that will join right away. What you'll see is as that ratio goes up, it means there's too many openings and not enough people to easily pull in. Unfortunately, that opening data only goes back to 2000, so you can't do this ratio prior to that. But what you'll see is we're at the highest point. I mean, we've peaked, thankfully, so demand has cooled a little bit, but we are still well above what we saw in the last two expansions in terms of labor demand. So that's the first place, right? Wages are still going up. People still have jobs, companies still want to hire folks. Even though we have high inflation and a restrictive Fed, this really has to turn before we can start talking about a recession. We have to start seeing movements up in the unemployment rate. The demand is only half of the picture, right? There's shortages everywhere, and they include the labor market. This is my favorite slide. I've been using this for a while now in this presentation. It required no modeling. But I think it is the most illustrative slide of both where we are right now and where we're going to be tomorrow, next year, and 10 years from now. So what are you looking at? This is the labor force participation rate. It's the number of people who have jobs employed plus the number of people looking for jobs, unemployed, divided by the population. So it's the folks you can poach or easily get to work. And for many, many, many decades, going back to the 40s and 50s, this participation rate for the whole economy was growing because women were entering the workforce. It was one of the biggest booms to our economy. And then you get to the 70s and 80s and things start to level off in terms of participation rate, kind of where it is now, in the high-ish mid-60s. And then it exhibited some really, interesting but also understandable behavior, which is every time you have a recession, that participation rate declines, right? You have people that get laid off and they don't want to be employed. They're out of the labor force. So the numerator declines, the ratio declines. In an expansion, folks come back in, they're pulled off the sidelines. That's what that term means. It means people that were not in the labor force, were not employed or not unemployed, deciding to be one of those two things. Then it gets pulled back in, the ratio goes up. So that straight line in the 90s shows you that prior to the recession in the early 90s, going all the way through that recession and then all the way through the next expansion, you gained 0.7 percentage points. Remember, peak before the recession, recession goes down, and then it slowly gains over the expansion. You end up 0.7 percentage points above where you were. That's millions of people. Seems like a small number, it's millions of people. Okay, great. We're better off after a recession in growth than we were before. But then something really strange happened, starting with the 2000 recession, which was very mild and likely kind of what our forecast is right now for the current situation is a mildish recession. So that 2000, early 2000 period is a good comparator. Where were we right before the recession? Well, we were up, 60, almost 67. And then recession, declines. And then the expansion. That participation rate continues to decline and then levels out. So you end up, after that expansion, 1.2 percentage points lower. After the global financial crisis, you had the largest expansion, the longest expansion, post-World War II. That number declines by 2.6 percentage points. That's millions and millions of people that decided not to work or are not available for jobs. After the pandemic, we're down 1.3 percentage points, and we're hovering at that. We've been hovering at it since the beginning of the year. All this talk of folks coming off the sidelines and coming back at holiday didn't materialize. Our participation rate remains muted and lower than where it was last time. Why is that? There's lots of reasons. I've seen video games blamed, and I always ask, which video games? Because it matters. Unfortunately, you have the opioid epidemic, which has really hampered certain segments of our population in terms of entering the workforce. You have some recent research that I find very interesting. I'm an old millennial. Recent research on what happened to millennials who graduated from college or graduated from high school into the global financial crisis. It delayed all kinds of life choices, family formation, job searches, those kinds of things that we're still feeling the effects of today. But the single number one reason that you see this chart is merely time. We're all getting older. Our population growth rate is not keeping up with the aging of our population. And so if you were to break down this chart into different age groups, and this is when I usually get things thrown at me. So if you're going to throw something, throw like a soft coffee cup. If you're above the age of 54, you are no longer considered a prime age worker. I know, government, not me. You're still very valuable to us. Those folks have actually been increasing their participation rate in the economy. But at a lower, it's in the low 40s. It went from the 20s to the 40s. That's a pretty big increase. But 40 is still less than 60, and the weight on that, so it's a weighted average. The weight on that isn't growing. So that 40%, as opposed to the 80% that you see in the prime age workers, 25 to 54, is outweighing that. It's pulling down this whole chart. But what that really means in everyday life is you can't find workers. And this is not a speedboat. This is a barge. You can't just turn this around tomorrow. There's only so many inputs to labor supply. Population growth, immigration are the two big ones. And unless we turn those things around, every cycle for the foreseeable future, it may not decline this much. There's going to be some floor. But we're going to be short on workers. We need that automation. We need that technological advancement, which again takes time. And so I hear these narratives out there on, well, recession is going to clear the decks, we're going to reset. Yeah, sure, to some extent, demand will come down. That first chart I showed you, demand for labor will come down, but so will this number. And then even if that demand comes down quite a bit, it will return, as we know, in the next expansion. And this chart will still be true. So we're facing a situation where workers have enormous bargaining power. It's why wage growth continues to be strong. And it's why we see a lot of people at work. And it's why we still can't yet call that a recession. We still have a lot of folks who are showing up to work, and we still have a lot of demand for those workers. So until that turns, we're going to have a difficult time saying the economy is contracting in a way that makes us think it's a recession. I know, I will stop here and say, we had 2 negative quarters of growth to start the year, and I got this question last week when I did this. Hey, you economists have been telling us for a very long time that 2 negative quarters of growth means a recession. Why is that not a recession? That's what happened the first half of the year. Q1 and Q2 both contracted. I'm not going to get into the details. We can talk about that in Q&A, but there were some one-off factors that caused that to decline. And the reason that we didn't call it a recession as a profession is one, the labor market, very strong as I showed you, and two, industrial production, which is one of the other metrics we use at when we date recessions, had its strongest start in decades through the first 10 months of the year. Strongest start in industrial production in decades. And so those two factors offset these one-off things, even though that strength got hidden in the growth numbers. The next time you see a contraction in GDP for 2 quarters, it's very likely going to go back to the old rule of that's probably a recession. You know, it's a very interesting, abnormal situation in the first part of the year. So I just want to put that out there. That is still a rule. It's still something that we think about. But until our labor market turns, we can't do that. But we're not going to call it that. So what are you looking at here? So on top of that picture I showed you with aging population and video games and the opioid epidemic and keeping folks out of the workforce, this is a new development that unfortunately seems persistent. That's the number of people out sick. So if you look at that pink line, that's the 2010 to 2019 average of the number of people every month in the labor force survey that reported themselves out sick. We have been above that, consistently above that, every month since really the start of the pandemic. I honestly thought this number was going to dip back down. And it's concerning that every single month, I mean, it doesn't even come down to the pink line, we continue to see an elevated number of people that are out sick. It's the same thing when you talk about childcare. If you showed this chart, we showed childcare, people that were out due to childcare concerns, it's the same thing. So we've got a new factor in our economy holding back the labor supply, and that's kind of this persistent number of people out. Maybe that turns around. Maybe this is just another bad year with RSV and the flu. But so far, this is 2 years of data. Over 2 years of data, it's pretty consistent. It's unfortunate. Now, it's hard to talk about the U.S. economy and not talk about consumption, consumer spending. It is 2/3 of our economic growth. 2/3. So I just painted a very rosy picture of the labor market. I said, well, people have jobs. There are more companies that want people than there are openings. Or there are more openings than you can pull people in from unemployment. And so you have a lot of people working, low unemployment rate, and strong job growth. That should lead to consumer spending. Here's the problem. We have a sequence of shocks that are affecting our economy, some of which we've talked about, that are real headwinds to consumption. We're in this moment of when is the other shoe going to drop when we talk about consumption. Every month, it's why the retail sales data, the personal consumption data, it's why that data is so closely tracked, because what I'm about to show you seems very, very dire. So it is somewhat inexplicable as to how these things are holding up. Because so far, the latest numbers have shown still decent consumer household spending. Okay, so the first thing when people make decisions on how they want to go out and spend money, as I'm sure everyone in this room knows, you've got 2 factors, right? You've got how much money you make every month, your kind of flow, and then how rich do you feel, right? To go back to Shane's presentation, do you feel rich enough to go to live? Is my house value going up? Is my equity portfolio going up? Can I go out and I'm going to spend money? Well, for the pandemic, we saw an enormous, that's a pink line, right? So the bars are the different categories in which of wealth. That pink bar is the summation of those things. And what you can see is that during the pandemic, that bar was quite high by historical standards. That's because you had this dual shock, or a positive shock, of equity values surging and house prices going up. And yes, we're going to talk about housing. It's a really big structural difference in our economy. So you had all of those assets going up. We all felt wealthy. We all went out and spent. The government did historic rounds of stimulus, $5.5 trillion pumped into the U.S. economy, many into bank accounts. And so everything was great. That's part of the reason we have inflationary pressure, right? We all felt wealthy. We took those checks, we walked out, and we spent it. But this year, unfortunately, this data only goes through Q2. This year, we've seen a remarkable turn. It's all in that green section, the equity section. Now, the research is a little bit cloudy on how much that matters, because there's a small percentage of folks that are able to buy equities, And we've seen when we do back of the envelope calculations, we've seen that the percentage at which you spend when your equity portfolio goes up is, every dollar your equity portfolio goes up, you actually only spend like 9 cents of it. So it's not a huge, 6 cents, sorry. It's not a huge increase, so it shouldn't be a huge decline. But still, that's a meaningful reduction in how we all view ourselves and our wealth. This chart's going to get worse as the real estate, that dark blue line, turns. That's not in here yet, and so that pink bar is going to get worse. So the wealth impact is going to be quite large. The other piece, and this is much more impactful to our everyday household decisions, is that real compensation has plummeted. What do I mean by that? This is wage growth adjusted for inflation. It's your purchasing power when you go out and you buy something. And so all you need to know is this chart, it goes down and off the chart. It's the worst we've seen since the 80s. So every time you go out, it's the Blueberry story, right? Every time you go out, you're going to the grocery store, you're going to buy a couch, you're going to buy a TV, watch some games. It is more expensive and your wages aren't keeping up. So, okay, well, if that's true, if I feel less wealthy and my paycheck isn't keeping up, why? This has been true this entire year. We're now in December. The November data we've gotten so far still shows strength. Why? How can this possibly be true? When is that other shoe going to drop? This is the $2.2 trillion question. What did I put up here? $1.3 trillion now. So what are you looking at? This is the amount of excess savings that were accumulated during the pandemic. So I'm going to explain how we estimated this because I think it's important to understand what the word excess means. We took the savings rate that we knew was, now it's not stable, the savings rate moves up and down, but we took the savings rate on average that we saw prior to the pandemic, and then we looked at what happened to that savings rate during the pandemic because it shot up. And we said, okay, add up all the dollars based on that gap between what we know used to be true and what we're seeing today, and then add it up in dollar figures. And you can see those blue bars are the accumulation over time of that savings, starting at January 2020. And so really what you're looking at is a couple of things. You're looking at some initial cost decreases. You're looking at persistent wage growth. You're looking at an economy that didn't shut down as much as we thought, so people still were able to work, but they weren't spending as much. They might have been spending more on toilet paper, but they weren't going out. Few people were on an airplane for the most part. And then you add on top of that a lot of government stimulus. So people just socked that away in their bank accounts. So at its peak, we estimate that was $2.2 trillion. Trillion with a T. It's an enormous amount of money just sitting out there able to be deployed. And it was pretty much gaining steam until around the beginning of this year. And then those dark blue lines start to come down. That's how we're getting through this right now. It's all the money that was socked away is now being used to offset high inflation and tightening financial conditions. And so the question then becomes, if we don't think the Fed's going to lower, which is that chart I showed you with accumulated Fed policy, if we don't think the Fed's going to lower, we think inflationary pressures are going to stay high. Now they're coming down, so maybe that chart I showed you with real wage growth, maybe that will turn back positive. We're not anywhere near that at the moment, but maybe. But how, even if it does, it's not going to be, you're not going to see a strong growth in real wages. So then how do we get to the other side? Why did I mention that we only think it's a mild recession? And the reason is we continue to run down the savings, which by our estimate, you would hit zero at the current run rate by August of next year. There's still almost a year at the current spending rate of savings left in there. And so that's quite a cushion to have when you're facing these enormous economic headwinds. But it's not going to last forever. And the other piece I will put in there is human behavior. It's sure, the we did a run rate and said, okay, we get to August. But people may stop spending before that if they feel freaked out, right? I mean, you may say, okay, I've got an extra $1,000 in my bank account, $5,000 in the bank account. Do I want to just continue to spend that when I think the world's falling off a cliff? No, you'll stop short of that. And so really, it may seem like we have August numerically. We probably don't have until then. Our estimation, we expect to see consumption begin to contract at the first half of next year, probably that kind of end of the first quarter. So there's some real concern out there. And it doesn't help that people like me get on stage and tell you the world is ending, right? Because then you're like, ah, this guy, he may know something. I'm going to go keep my money. And you can see it in the consumer sentiment data. When you ask consumers, how do you feel about the economy? They're telling you they don't feel great. And so this is kind of that every month matters. Every month the retail sales numbers, every month the consumption data matters. And when is that other shoe going to drop? Just to hammer this point home, though, I want to show you the accumulated savings. I showed you kind of like across the whole economy how much money was saved, but who saved it is also important. So what you're looking at here is the accumulated savings, the change in savings from the first quarter of 2019 to the second quarter of 2022 by income distribution. So keep in mind, the government, when they came up with the pandemic stimulus, those 3 rounds of it, now it's never goes exactly how you want it to, but when they did that, they targeted folks in the lower half of the income distribution because they know what I'm about to tell you. Folks at the bottom end spend their money at a higher rate than folks at the top end. And I'll tell you the numbers in a sec. But just before we get there, what you can see what this chart clearly shows is that folks at the top end of the income distribution, this is cash, right? This is deposits. This isn't just equity accounts, have amassed, on average, $93,678.86 relative to the first quarter of 2019. Then there's a big drop off and it steps down. And what you see at the bottom 20% of the income distribution is that they're actually in the red to the tune of $1,600. So all of that stimulus went into the economy. All of those targeted programs, many of those folks are working in industries, in-person industries that are where the wage growth is the highest, and their bank accounts are still lighter than where they were before the pandemic. And there's 2 reasons for this. The first is where the inflationary pressures have existed and persisted is exactly the places where those folks spend at the highest rate: food, energy, cars. That's been particularly hard on those at the lower end of the income distribution. Okay, so that is a really sad, inequitable story. But let me give you another reason why this matters for the economy. For every dollar in income that you give someone in the bottom quintile, they spend 55 cents of that on average. For every dollar of income you give someone in the top quintile, they spend 12 cents. So, surprisingly, as an economist, I'm not great at math, but I know that 55 cents is more than 12 cents. So the folks that are losing money, they're seeing those real erosion in real incomes, and now they're seeing their bank accounts dwindle, are the folks you need as the backbone of spending to our economy. Again, when is that other shoe going to drop? It's not a great sign for consumption. Now we're going to talk about the other really uplifting piece of our economy in the housing market. I'm not even going to sit on that slide. We're going to throw things at me. No joke. I did this in Orange County for some of our partners back in the summer when things looked like they started turning. And there were 2 gentlemen in the back who were just adamant that this is 2008, 2009. And it was like question after question. I remember being there, I was like, oh man, these guys are really they're going to grow me. And I walked off thinking, because at that time we were saying this is not going to be a 2008, 2009 event. I just went back to Orange County because it's not going to be so far not 2008, 2009 event. I was all ready to be like, ha, 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 I told you guys, it's bad, but it's not that bad. They didn't show up. Didn't get my moment. But that's a joke to offset, a little bit of the pain I'm about to tell you, which is that the housing market's in a bad place. right? We have had in a historical run-up in house prices in the pandemic. The other story I have on this is that right as the pandemic set hold, I was still at the Fed. My buddy in San Diego called me, and he was like, look, we got 2 kids. We want to buy a house. And I said, dude, it's a global pandemic. Buy a house, just wait. You know, you're gonna have your pick. Thankfully, he didn't listen to me because house prices in San Diego went up like 30%. You know, there were very few people that saw that coming, and it was due to that labor market stuff that I showed you. It was a shift in the labor market, right? People able to work from home increased the demand for housing. That's probably going to continue to some extent. So prices skyrocketed. And then you had the sequential shock of the fastest rise in mortgage rates in decades. So you have a huge, simple math, huge increase in the value of the asset, and then the cost of buying that asset went up. That became very untenable for many folks, first-time home buyers. So affordability measures have plummeted. First-time home buying is off, and understandably, that light blue line, which is the Home Builder Sentiment Index, folks building the homes, they don't feel great about it, right? It's rolling off. They're telling you, look, the housing market, it's bad, construction's down, that dark blue line, that's housing starts in millions, that's coming off. And they're telling you, that light blue line is kind of telling you we're going to see more of that because we don't think house prices are going to come down as fast as interest rates have gone up, but we do see a pretty sizable 20%, back of the envelope what our housing economist says, decline in prices over the next year. But that's still, if you do the math, some markets that takes you back down to where you were before, maybe a little below, and other markets are still up. So it's not 2008, 2009. You have to go in knowing you don't see the financial weaknesses that you saw going into that. We don't see the bad lending, and it was preceded by an enormous run up. Right? The problem with growth rates is if you spend too much time on the current growth rate, you forget what happened before. We're coming off a very high level. And so with this construction decline, with this strong cooling and contraction in residential investment, that's going to be another place that affects both the economy, because this shows up in the investment number, and it's going to affect people's consumption because, when you buy a house, you often fill that house with new things, couches, televisions, PlayStations, so you can play your games and not work. So these are some really strong and unfortunate headwinds to the U.S. economy. And I'll go quickly through this chart. This is just to prove to you that I'm not crazy, and it just shows up in the data. We've had the 2 worst quarters of residential investment since the subprime crisis. Now again, I want to it's bad. It's looking like it's going to stay weak, but I just want to level set this. This is a change. So it's not showing you the level, and we started at a very high place. So some coming down should be expected. All right. All of that build up to talk about this section, recession, the R word. I've been doing this for about 15 years. And this is the first time in my short career that I can remember, I've lived through 2 recessions now, I can remember all economists agreeing a recession is coming. Usually what happens, it's kind of a joke, is we wake up one day, we jump on Twitter and we're like, hey guys, guess what? The data from 2 months ago came out. We're in recession. Everyone's already been laid off. And so we are the last people, unfortunately, to see the recession. So it should be telling that most of the profession this time around has been talking about this for a while, because we all kind of agree. The story I just showed you, it's really hard. There are folks out there that will tell you that it's not coming, but it's really hard to get around just the basic facts that we have some strong headwinds to consumption and the housing market's really cooling off. And of course, with rising interest rates, you get tightening financial conditions and borrowing conditions for businesses. But let me just show you a chart. Economists are like really cheap lawyers. We make arguments in charts, not words. So let me prove to you that that's true. So what are you looking at here? This is a model that uses the yield curve to predict a recession. Okay, a couple of things. What's the yield curve? For those of you that may not track financial news, it's kind of in the weeds. The yield curve is merely if you drew out kind of a line that I'll do it your way. If you drew out a line of interest rates, yields on treasuries at different windows, 1 year, 3 year, 5 year, 10 year, what you would see in normal times is that as you go further in maturity, you get higher interest rates. It makes sense. Further out, there's more risk. And so to compensate for that risk, you need to have a higher interest rate. So the yield curve makes a nice kind of bend and then levels off at some point. So in that world, if you took a 10-year maturity, let's say, and subtracted that yield, 1-year yield from that, you would get a positive number, right? Further out, higher up, closer to today, smaller, so you get a positive number. In certain moments, and this is not necessarily causal, it's more just predictive, but over the last 4 recessions, we've seen that relationship break each time. So that means a yield curve inversion. When the long end of the curve comes down below the short end, you get a negative number when you do that subtraction. That's pretty predictive of a recession. And so what we're seeing right now, we saw some yield curve inversion in March, and then it kind of uninverted for a hot second, and now we're seeing some pretty strong inversion along different parts of the curve. That doesn't mean a recession is inbound today. It means in the next 12 months, we're likely to see something. And that's what this chart is. Based on that, we stuck this in a model, and we said, what's the probability in the next 12 months of seeing a recession? And what you can see is we're at the highest, that's the highest probability since, again, to use that analogy, the 80s, right? Just looking at financial markets. Everyone's kind of expecting that we're going to see it. So much so that every time you get data, you got this weird thing going on in equity markets. Every time you get data, positive data on the US economy, the stock market goes down because people are afraid of what the Fed's going to do because they've already they're like, well, a recession is coming, but how bad? Oh no, the data is better than we thought. The Fed's going to tighten more than we thought. The recession is going to get worse. That's the thinking in financial markets at the moment. And so this number is likely to continue to go up. But we think, unfortunately, we're either in it now or very likely going to see it in the first couple months, first quarter or so of next year. That's what this chart is. This is our forecast of economic growth going through next year, and it's broken down by major sectors of the economy. So what's driving kind of the change in growth? And you can see, I did this, we updated our model, we updated our forecast on Monday. And so when I did a talk like this last week, this chart looked a little bit different. The big difference is that consumption piece. It was pretty small in our November forecast because the data looked like it was slowing, and everything I told you, we should see it. And then the numbers have continued to come out strong in the fourth quarter, so we've upped our forecast a bit. But you can see the exact places in which you would think there's going to be weakness. Residential investment, as I just discussed, the housing market's rolling over. That pink section is looking like it's going to stay negative in our view for the next, for this quarter and then the first half of next year. Well, really through the third quarter of next year, and then it starts to improve at the end of the year. And then you can see with consumption, this is kind of the last quarter in our view, that you're going to get that big consumer boost, and then it really slows off at the start of next year. That kind of dark blue, black section just gets squished. Now, it doesn't contract over the whole quarter in our view, but again, 2/3 of the economy. So that's, even if it goes from big to small, the other factors will then weigh, it doesn't offset the other things happening. And that's going to cause some weak negative GDP growth in our view in Q1, and then you can see consumption roll over for a quarter into negative territory in Q2. So not great news for the start of next year. Interestingly, that light purple bar, you might say, what's going on there? That's net exports. What is that? That's exports minus imports. What's interesting is I'll start by saying this. The global economy, as bad as it may seem in the US, the global economy is unfortunately on worse footing. And so that can affect this number a couple ways, right? Well, if the global economy is on worse footing, I may import. There may be less things to import, right? I may want to import, but there may be less things to import. But it also may affect exports. I might be able to send less machinery to Europe, for instance. They're a big importer of US machinery. And that's what this purple bar is telling you. That export number is we expect it to drop out pretty substantially because the rest of the world is kind of in a weak spot. And I would say that's one of the areas where I think most forecasts are pretty uncertain, is that rest of the world piece. Because there are a lot of things happening over shores in China, obviously in Europe, all over Europe, not just in Western Europe. And so there are South America. So you've got many places in the world that are linked together that are being hit by continued shocks. And that's going to be a very big headwind for our export sector. Hopefully things get turned around. You know, it's not, and we start to see exports pick up at the end of next year. But if you're in an export-related sector, it's likely to look weak for a little while. But so when we talk about recession, I'm telling you there's some quarters of growth. I'm telling you what's going to drive it. How does this recession stack up? If you believe our story and our forecast, how does this recession stack up with previous recessions, right? It's all about ranking. And so there are a couple things here. What this chart is we took think of it the trajectory of the economy starting at the recession and kind of how that evolves. So when the line goes down, it means that the economy is contracting. When the line goes up, it means that it's growing. And that straight up and down line is kind of the 100. It's the reference point. So when one of those lines goes above that, where it was, and when you get that straight line, that tells you the economy has gone out of recession and is starting to, it has evolved into expansion. It's higher than where it was before the recession. And so again, we did this chart on Monday. That pink line, which is where we are today, was much lower. So if you just look at that, you can see that all of the chart I just showed you with the contraction in consumption and the continued weakness in exports for a while in the housing market, it still means that pink bar goes down just a little bit, right? It's a fairly mild recession. And then it starts to go back up in the middle of middle to end of next year. And then we have a kind of, an expansive economy again. Contrast that with that purple line that's at the bottom. That's the 2008-2009 financial crisis. 8 quarters in, the level of economic activity was still below where it was pre-recession. That was a very deep, very prolonged recession. So even though the headlines are scary, even though I've been arguing for 30 minutes that the household consumption is going to slow for all of these reasons, we still only get to a mild recession. So be scared, but don't be too scared. Now, we're at a moment, Shane pointed this out, there's a lot of instability and uncertainty, and I would say the bands around our forecasts are pretty wide. They're always, there's always kind of error corrections, but they're particularly wide right now. So you have to take all these things with a grain of salt. And if I were to show you the bands in our forecast, kind of think of it like an imaginary gray section that hovers around our pink line, it would be tilted towards the x-axis, towards the downside. Meaning, we're more likely to be wrong and the recession is worse than we are to be right and and we're not going to get a recession. So that's how, when I opened up and I said, hey, I want to help you think about how the economy is, this is exactly that. It's not just about what the point estimate is, it's where the risks are. And the risks are still to the downside with weak global growth, weak housing market. Consumption could turn even more than we think it's going to because of those headwinds. So when you're going out there, that shouldn't keep you from going out and generating business and talking to folks. It's just to be conscientious of that. To know it's a very uncertain economic environment and that we're going to see, and that we have to be reading the data every month to see where this forecast ends up. I mean, again, we shifted this quite a bit. So, okay, mild recession. I've talked about the importance of the labor market. What's going to happen in our view to the unemployment rate? That's the big question, right? Jobs drive consumption. Consumption drives the American economy. So we're at about 3.6, 3.7 unemployment rate right now. That's very, very low. It's near decades lows that were reached in the last expansion. So when we're talking about a recession, you always have to start with how much does the unemployment rate go up? So you can see, I'll get to the end, you can see that pink bar on the right, we have that at 5.3. So less than 2 percentage points, if I do the math in my head, less than 2 percentage point rise in the unemployment rate. That's still millions and millions of people. That's still very painful, causes a lot of suffering. But look at that in context to history, right? Again, these aren't changes, this is just the level. But 2020, 13%. Well, that's a weird time, throw that out. Okay, global financial crisis, 9.9%. 2001, another mild recession, 6.2%. Our forecast is below that by a sizable margin. That's another piece of this, right? Like when you start from a low base, when you have supply shortages in labor and it's very high demand, even if the unemployment rate starts to rise, to get to a catastrophic global financial crisis, you either have to see complete destruction in the labor market, or you have to see a destruction and real systemic issues in the financial system. Now, there are places to be worried about that, and we can talk about that in the Q&A, but we're not seeing a singular event like we saw in the housing market at this moment. So again, if you don't have the just widespread destruction in labor that we've seen previously, you have and you don't have that, you get a mild recession with a less than 2 percentage point increase in unemployment rate. Still very painful, still a recession, but not the kind of thing that should have us going through quarters and quarters and quarters and quarters of contractions and sluggishness. Now, the other piece I want to point out, and I mentioned this, we'll go quickly through it, is that the global economy looks worse than the US economy. I used to work at the International Monetary Fund, the IMF, and twice a year, they put out their World Economic Outlook. They do a very comprehensive look at every country that they can get data for, which is most countries, and they come up with a global growth forecast. This was put out in October, and you can see they're slowing. 5.8 global growth last year, 2.7, estimated 2.7 this year, 1.9 next year. I think if they did it again today, those would probably be even lower, and you maybe even see a negative on 2023. But the rest of the world is looking a lot weaker than we are. All right, this is my last slide. And I wanted to bring us back where we started to inflation. I have 2 small kids, 2.5 and 1, so I don't sleep, ever. And so one night I was up, and instead of going, binging Netflix or watching an NBA game, I decided I would do some inflation modeling. And so I just had this burning question. I was like, okay, we talk a lot about how much, a recession, we talk a lot about prices coming down. You hear all this discussion around a whipsaw in pricing when it goes up, and then a lot of people are saying, well, what if it comes down really fast? And I just thought to myself, what does history say about that? Like if we go back and we look at this core PCE inflation, the inflation that the Fed tracks, how often do we get negative numbers, right? If I just look at the monthly growth rates, how often is it negative? So I went back to 1959, every month back to 1959, and I just said, okay, simple exercise. I'm going to just calculate, we're just run a quick algorithm here, calculate all the monthly growth rates, and my prior to this was like, probably like 25% of the time, right? My guess is about 25% of the time this monthly data is going to show a contraction. Anyone want to guess, as a percentage, the number of times monthly inflation has contracted in the last 60-ish years, 70 years? 2%. It almost never happens. Even during recessions, that monthly core inflation number continues to grow. It blew my mind. And people out there were like, what's wrong with this guy? No wonder he wasn't fun at parties. It blew my mind. I mean, you would just think, just from a sampling standpoint, you'd see a lot of ups and downs. So then I said, okay, well, if that's true, let's assume that we're getting a recession, and let's look at let's take a couple comparative recessions. Let's take the average inflation rate, monthly inflation rate, and then grow it from where we are today. Grow that 12-month index from where we are today. And how fast do prices come down? I thought, well, it's going to come down. Like, we could get to 2% here. In a perfect world, mild recession, we get to 2%, in February or March. So what you're looking at, what those three lines are, that black line is the actual reported core PCE growth rate, 12-month change. The dotted line's the Fed target at 2%. And then I ran three scenarios. First, the global financial crisis. 17 months, I believe, was the length of that recession. And 4 of those months, if memory serves, you saw a negative contraction in the monthly change in prices. So all of the inflation, deflationary. That growth rate, I applied that across, it was a very weak period for price growth. I applied that across, you get the pink line. At that rate, our current level, we don't get back to the Fed's target until the early part of next summer. If you took the 2001 recession, which is the one I keep comparing it to, which was a period of very low inflation, just to start with, and tomorrow, when we get the inflation data tomorrow for November, if that just all of a sudden slowed markedly, it would take until the middle of the summer, end of the summer, to get back to the Fed's target. And then I ran a thought experiment, right? We're getting 0.3, 0.4% growth rates on inflation. Who cares? Well, it used to be 0.18, 0.2, right? So double the pace of core inflation at the moment. And I said, well, okay, what's the rate, the monthly rate of inflation, if it's just the Fed's target, right? So if I want to get 2% over a course of 12 months, what's the monthly growth rate have to be? That's the black, that's the dark blue line. At that rate, you don't get back to the Fed's target until next fall. We're nowhere near these at the moment. Now, data could always change, but history tells us we're not going to see a lot of negative growth rates, so you have to wait. That's what the Fed is doing. They're waiting. They're raising rates. They're hoping that they've done enough, if we're right, stopping at 5.5, and they're just waiting for this price growth to come down. And history tells us it's not going to come down very quickly. We think it's going to come down faster than the Fed does. Their forecast looks different. But to me, at least, when I talk about next summer, we don't get inflation now until next summer. If you use the growth rate used during the global financial crisis, that to me says it's going to take some time. So I'm going to stop there. Got my thank you slide. That's a lot of information, but please don't be bashful. I'll answer any question once. I may not answer it well, but I'll answer it. And then we may have some stuff coming in from online. But thank you very much for letting me come out to Miami and check out the ocean out here. It's much warmer on this side of the country. So, nobody? No brave souls? There we go. Shout it out.
Can you describe what was so inconsistent for Mrs. Yellen and her cronies to be so far off on her transitory inflation comments?
The question is, what happened in the last Fed and why were they wrong about inflation, right? Like, why were we calling it transitory? Because this guy was calling it transitory too. It's a great question. And the reason is, forecasting inflation is really, really hard. There's only a couple ways to do it. I'm not going to defend the Fed because I think you could take issue with a lot of the policy decisions they've made in that time. But just the act of forecasting inflation, to go back to first principles, why are we having this discussion? What do you take away from this? It's very difficult. There's only a couple ways to do it. One of those is to look at what's been happening. So if inflation's been low, your model's going to tell you inflation's going to keep staying low. Right? That's the unfortunate statistical nature of it. The other is to look at these other variables and try to land the plane on a runway and come up with a number based on wage growth and where you think consumption is going to go. Also, like shaking a magic 8 ball. So when you looked at the economy and you said, well, supply chains, that shock to supply chains, we kept saying it was going to dissipate. Well, that didn't dissipate. And then I think a lot of people underestimated the amount of demand creation from that stimulus, right? I'm not going to get into right or wrong, should the stimulus have happened or those 3 rounds of it, but there was an enormous amount. It was definitely inflationary. So you had those kind of dual shocks of being too optimistic about supply chain alleviation and not understanding well enough that increase in demand led to, I think, some very optimistic inflationary projections. The Fed is by no means under that model anymore. They are all on the inflation fighting train. So for any of you that feel that that was a mistake, have no fear. This Fed is there to slay that beast. But I think that's probably what happened. Question in the back? Oh, yes, right here. Sorry, the lights are bright.
It's kind of a related related question. A lot of the Inflation Reduction Act has given a lot of money in the green industry for domestic manufacturing and credits. And currently, developers in the green industry are facing very high prices due to the supply chain disruptions and issues in China. Do you see U.S. manufacturing taking advantage of this credits and also not having this pressure of China on us from political side? Do you see U.S. manufacturing picking up in these areas of green, in the green industry?
Yeah, that's a really interesting question that touches on, I'm going to broaden it a bit and talk about the structure of the economy, because I think industrial manufacturing is sitting with housing and labor at kind of this center of the structural change in the U.S. economy. We've had a couple things happen, right? We've had a lot of support from the government, CHIPS Act, and incentives to build factories here or in North American trading partners. You have actually for decades, you had a very big wage differential between many places in Asia and here. There's still that differential, but it's closed a lot. Asian labor for manufacturing has become more expensive. And then you've had the supply chain, destruction of the supply chain, which is causing many places to rethink how they price in risk. They may be willing to have a more costly operation if that means resiliency to their production. So those things all speak to kind of a positive impact on the manufacturing sector. That doesn't mean it's not going to get hit by a recession, right? I mean, it's hard to draw up on a piece of paper when you have capital costs rising like they are in an economy, even with mild contraction in consumption. And then you're looking at the housing market and say, well, IP is going to roll right through. I don't think that's going to happen, but I don't know if I'm maybe a little optimistic. I don't see there being kind of the demand destruction you've seen in other recessions for some of those reasons, right? Companies also for a while had their profits are looking weaker now, but there was a strong accumulation in profits for most of last year. There's money to deploy there. So as they're thinking through these longer term problems, I do think that puts a floor on how far manufacturing can go. And I think you're right. There's other spots around the world that for many reasons look less attractive. It's a very good question. Yes.
So a quick question, and you just touched on it briefly. So considering that it's looking like a milder recession ahead, what do you think how would that impact companies' short-term goals? So companies thinking about their current guidance or metrics and targets that they put out there, are we suggesting then just in the short term that there would be not so much of an impact?
No, I wouldn't put it like that. The language matters. I'm going to lean on one of the preeminent economists of our time, Ben Bernanke. He said it about monetary policy, but I think it's true for what we're talking about here too. He said 98% of monetary policy is communication, 2% is action, right? It's all about behavior, changing behavior, helping people think things through. And so in that sense, when I go out and I talk to clients, and I'm in San Francisco, so I've been talking to a lot of tech clients, that's the sector that's been in the headlines for the demand destruction and equity evaluations rolling off. Their view of things is they're kind of waiting for the shoe to drop. What I tell people in the situation is, look, you're dealt a hand, right? This is what you get, in our view. What can you do with it? And so there I want to go back to what I started with, which is you've got to talk about opportunity, right? Capitalism is not ending, right? The U.S. economy is not going to fall in on itself, not from this. And so what we know is that there will be spots in the economy to add value. But in my view, and I'm taking off my economist hat and putting on my chief of staff hat when I was at the Fed, you have to align your organization to that. The first place that I always think of when we do this is humble forecasting, right? I make the joke often, because it's true, that in baseball, you bat 300, you're going to the Hall of Fame. In economic forecasting, if you're right 20% of the time, you're a legend, right? That should tell you all you need to know. 80% of the time, something is not right. So start there and know that that's true. Well, if you know that your point estimate's not going to be right, what's the next thing you do? Think through scenarios, the last chart I showed you. It's a thought experiment. What could break? Where are the pressure points? It's beefing up that enterprise risk in your organization. It's being cautious, but it's not withholding everything, right? If you've got capital to deploy and you think there's an opportunity, you may be right, you may be wrong, but is the process right? Right? Did you make a sound decision? Don't sit on the sidelines. You'll miss opportunity. That's what I like to talk to clients about. So it's cautious. It's understanding you need to have strong resiliency in your enterprise risk and thinking through scenarios and understand the weaknesses in your forecasting. And it's not trying to like make the forecast better. Of course you want to do that, but there's limitations. Start with this is what we can control. I've been hearing that more and more. Wrap it up. Can you do one more? Maybe. Okay, I'll go quick.
Do your models incorporate the restart of student loan payments? And if not, do you think the restart of them, which I think is sometime next year, middle of next year, going to have a measurable impact?
It starts soon, I know, because I'm paying. I'll do this real quick. Yes and no. Yes, they will have an impact. Our models do have that incorporated. They will have an impact, but not as inflationary as you think, because people know it's coming. It's that expectations piece. Thank you so much for letting me talk. We have a break, and we'll be back, I think, at 10:35. Thank you so much.